Thursday the 12th of March 2020, a day which will live in infamy. The FTSE 100 fell by 10%, the largest drop in a single day since 1987. In the weeks that followed, the markets continued to fall, and then rise a bit, but have we now seen the bottom?
Driving the crash is the fear of the unknown. Most businesses are having cash flow issues, there is employment uncertainty, and every word from politicians and the World Health Organization are being seized upon by the markets, and prices are moving accordingly.
Oxford Economics recently predicted a V-shaped economic recovery, a sharp economic decline, followed by a sharp economic revival, near complete economic repair.
Like all economic forecasts, it is a guess. But does it carry weight? Investing during a normal recession is great because you're buying when the prices are low, but it still may take a few years to make a profit. Whereas during a V-shaped recovery, we could all be cashing in massively within months if we invested now.
We're not saying that there definitely will be a swift recovery, only that there is a better than normal chance that this recession will end up that way, and so investing now gives you the best chance at fast riches.
Is this our generation's best chance to cash in on the stock market? Let's check it out. Welcome to Unshackled.com, the investment channel and website that sets you and your finances free.
That was Andy and I'm Ben. Be sure to tune in Mondays, Thursdays and now Saturdays at 6 PM UK time. That's right, MU has gone to 3 days a week. If you like what we say, hit the like button and click subscribe.
Take advantage of the recovery by using the bonus links on the office page at Unshackled.com. Part of my wealth is held in the robo-investing platform, Nutmeg. This smart app will build and manage a diversified portfolio for you using technology to keep fees low. If you are a beginner, or like me, you just want to invest and forget, open an account with Nutmeg and get your management fee reduced to 0% for the first 6 months when you go through our link. Now let's get into the video.
No ordinary recession. Unlike the 2008 crash, which followed years of questionable economic policies, the economy today is just on pause on the orders of world governments. In a normal recession, the problem is that people don't want to go out and spend their money, whereas now people would just love going out to restaurants, to the cinema, or going down the pub. In other words, like a coiled spring, the theory is that the economy can bounce back into normality as soon as the government tells us we're allowed out again.
The elusive V-shaped recovery. The holy grail of stock market opportunities is the V-shaped recovery. A fast crash allowing us to buy cheap, defeated swiftly by a sharp bull market recovery back to pre-crash prices. In the Great Recession of 2008, nobody was thinking that there was going to be a fast recovery because the economy was broken. It was going to be a long slog to get past the problems in the banking system.
The 2008 recession. L-shaped recovery. It took markets 2 or 3 years to recover from the 2008 recession in more of an L-shaped recovery, but recover they did. It's called L-shaped when the market crashes quickly, then flatlines before gradually climbing back much later.
Annualized gains, why speed matters. V-shaped or L-shaped or any other form of recovery, history shows us that a crash is always the best time to buy. The speed with which the market recovers matters insofar as whether our annualized return is either good or massive.
As an example, a slow 3-year L-shaped recovery might net us annualized returns on average of 10%, whereas that same recovery over the course of 1 year in a fast V-shaped recovery would net us 30% annualized return.
Should you invest now? While we can't give you advice, we think you should at least be investing some of your money now. Even if the recovery isn't quite as fast as some people are predicting, you'll probably still be making good returns.
How can you be confident that the stock market will go up again at all? Although it currently feels like we're living through the end times, it's worth remembering that this is not the first epidemic that has hit the markets. In the last 40 years, the stock markets have been rocked by HIV, AIDS, pneumonic plague, SARS, bird flu, swine flu, MERS, and those were just the health scares. The stock market has of course been shaken by other crises during that period, such as Black Monday, the dot-com bubble, 9/11, the credit crunch, the Japanese earthquake, and the EU referendum. And yet, the market has always bounced back after a crisis. America is the main economy in the world. An American stock market index, the Dow Jones, grew over this 40-year period from 2,600 in 1980 to around 23,000 at time of filming. A 900% increase. The grey areas represent previous recessions. The world carried on.
Reasons to think a V-shaped recovery is possible. More and more experts are talking about the possibility that half the country has already had coronavirus and have just not shown any symptoms. While this sounds unlikely, If this is true even in just some parts of the country, then a faster step return to normality might resume. The thinking from some commentators is that the virus will be difficult to contain in built-up cities like London despite social distancing, and sooner rather than later, enough of the city will have already had the virus to justify ending the lockdown there.
There could even be a stepped return to normality via age group, allowing young people out first, presumably the lowest at risk. The government stimulus packages have until now stopped workers from losing their jobs or their pay, stopped the self-employed from going bust, and stop businesses from having to pay business rates. In effect, the economy is currently just in a deep freeze, waiting to be thawed out.
The V-shaped recovery model predicts that the economy will be back to pre-crisis levels by early 2021, and if this turns out to be true, then investors in the FTSE 100 could see a 50% annualised return from its low of 4993 back to the 7600s.
China will be a key indicator over the coming weeks as to whether this will be possible. At the start of April, the Chinese government removed lockdown and people went back to their daily lives. Western satellite scans of nitrogen dioxide concentrations over China, which denote transport and production activity, support the spending statistics from within China that in the last couple of weeks life in China has been returning to normal, and the satellite data at least doesn't lie. When people are released, there is the will to spend. The risk to the stock market being prevented from a V-shaped recovery now would be if China suffered a second wave of infections, as this would shake confidence and affect supply chains.
U-shaped curve. Now, more in vogue amongst economists like Bloomberg, a U-shaped curve is middle ground between an L-shape and a V-shaped curve. It assumes that we might not see the bottom of the crash until later in 2020, followed by a slower recovery, because some lasting damage has been done to some businesses that couldn't cling on for that long.
Even under this model, we see a full recovery of the markets in 2021. Remember, these are models, not facts. But we think the mood coming from the news outlets that the economy is coming to an end is fundamentally misplaced.
What needs to happen for a fast recovery? The money and fiscal stimulus from the government, along with historically low oil prices, put the UK economy in a favourable position to bounce back once it's allowed to get up and running again. But to bounce back, COVID-19 needs to be tackled fairly quickly. Boris's insistence on 12 weeks to turn the tide needs to be mostly right, and then normality has a chance to resume in the second half of 2020. More practically, a test needs to be rolled out in short order to every citizen showing who has had the virus, as those people could presumably then get back to work and back into the economy.
What could stop a quick recovery? Time. This is an unprecedented situation, and the companies that go bust during this crisis won't come back. The longer this drags out, the more companies are lost forever, leaving cracks in the economy.
Conclusion for investors. During a crash, we would be buying anyway, but with the chance of a V-shaped recovery, we think this could be a once-in-a-generation chance for a quick win.
While if you already hold a good-sized portfolio, you will be looking at your losses and despairing. Especially during a crisis, it is difficult to think long-term and imagine how life will look afterwards. But time and time again, we have seen markets drop, only to come back stronger.
In these uncertain times, and given the difficulty of predicting the price movements of the market, that we think it is best to stay calm and stay invested for the long term. For new investors, during the next weeks, the economy will be coming up with new and creative solutions, and the hysteria across different sectors and geographies will create opportunities. Will you be investing? Let us know in the comments below. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.